It's 2007, you've just joined PDT Partners, and the firm is down $500 million.
At first, no one really knew what was happening at all. Do you just shut the whole thing down? Do you try to weather it?
How do you know what to do?
Oh, you don't. You have to make a decision as to whether you still trust your model.
Meet Vinesh Jha. He's worked at PDT Partners under Morgan Stanley and is now the CEO of Extract Alpha, a data provider that offers unique data sets to give clients edge.
A lot of investors out there are using the same stuff, similar models, right? But also because the underlying data is the same. If you're starting with the same stuff, you're going to end up with something close to the same stuff across different funds. But that didn't have to be the case.
One of Extract Alpha's products includes Estimize, a crowdsourced community of financial forecasters.
You've been in this industry for quite some time. What makes the exceptional players in this space?
Yeah, it's probably a combination of things. One would be
Vinesh, it's 2007, you've just joined PDT Partners, and the firm is down $500 million. It's the Quant Quake. What was that experience like?
the Quant Quake. Was a weird experience for sure. I think anyone who has kind of spent their career on systematic models and quant models, you have certain expectations for how this thing is supposed to work. And when that breaks down, it can be kind of chaos. I mean, you model the world in a very specific way, and you don't expect to see these, high number of standard deviation events. I mean, that's the whole point of doing this sort of modeling, is you think you've set those expectations. And when they're exceeded in some way, positively, negatively, you start asking a lot of fundamental questions about what you're doing. I was really new to PDT at that time. I'd been doing quant research for many years at that point, but I was new to PDT. And I'd gotten in there a few months before, was building out my models, was helping, deploy them. And suddenly this happened over the course of those 3 days in early August '07. It was definitely a pretty baffling and weird experience, and unclear what to do. And, at first, no one really knew what was happening at all. We were operating in a very limited information environment. The first day of losses, was massive, starting in the US for the most part, and, later spread to other markets. And not saying anything proprietary here, this is sort of well documented across many funds that experienced the Quant Quake, right? And then it continued. And, so the question arises, what's going on? Do you just shut the whole thing down? Do you try to weather it? And the weird thing was that there was nothing going on like in the markets, right? The markets were pretty calm those few days. It's not as if stocks were experiencing these huge, price movements on average for the average long only investor. It's that very specifically quant funds were experiencing it. And normally quant funds, you wouldn't know that. You wouldn't know that your competitor down the hall is experiencing a loss normally on a normal day. But when it's so large, people do start picking up phones and calling each other. And there were a lot of sort of behind closed doors kind of conversations saying, like, what are you seeing? What are you seeing? What's going on here? That's how we kind of learned that it was pretty widespread, but isolated primarily to quants who are trading, as it turns out, very similar strategies. I mean, back then, the quant world was smaller, but it was also, there was less movement between places, and a lot of the strategies that people were using, they might have thought they were unique, but it turns out they weren't, or at least were not completely unique. So the underlying cause for this, as you've probably heard at this point, is that somewhere someone is liquidating a portfolio of quant strategies. And so they end up selling whatever's long and buying whatever they were short, covering their shorts. And if those are the same longs that we had or the same shorts that we had, then that could cause losses in our books too. And so that was what's happening across the quant world. And those were not necessarily stocks that were, otherwise would be held by the average institution. Specifically, quant models were holding them because they were picked by these sorts of factors that were commonly used factors at that time. And so, yeah, I think there's probably an element across all the quant funds of kind of panic, honestly, and differing opinions on whether you should sort of stick to your guns. I trust these models. Is a temporary dislocation, or we don't understand this, it keeps going on, we could lose our shorts over the next few days. I think, opinions varied widely, and there were a lot of kind of heated discussions around that time, not surprisingly.
When you're in that position and, suppose something's happened that, you've never experienced before, and you have no idea why. And I think you touched on it a little bit earlier. How do you know what to do?
Oh, you don't. That's your easy answer. You don't know what to do. Now, I think if, knowing what you might have known by the second or third day of that event, it was essentially a 3-day event, and then it snapped back on the 4th day and 5th day. But if you're in day 2 or 3, I think you have to make a decision as to whether you still trust your model. That's essentially the first decision, right? Do you still believe that in the long run, the models are right, they're likely to correctly forecast the direction of an asset's returns? Is there something fundamentally wrong with them? And I think, my belief at the time, and my belief has been throughout, my career, that I try to be really, really careful with the models I build. And that doesn't mean they're perfect. No models are perfect. And some of them stop working. And if they stop working, usually it's, for a reasonable reason. Like it's predicting something fundamental, but the market doesn't care about fundamentals, or it's an overcrowded trade or something like that. These are sort of explainable things. If you don't have that explanation, then it's something that has to do with something that's going on in the market right now that's more likely to be temporary. So if you believe that your models are decent and that the dislocation is temporary, then the only question becomes whether you turn off the model for a while or you keep it on. Or in somewhere in between where you dial back the risk, right? So it basically becomes sort of a risk on, risk off decision for the short term, with the intention that, when this is all over, you turn it back on if you believe your model still. And so if you're faced with that decision, it really becomes more of a question of the type of institution you're in, whether you can weather the loss, whether you have investors who are going to demand an explanation, whether you have investors who could pull the plug and then you're just done. And so I think, the answer was quite different between different institutions. For example, some hedge funds which had their investors had monthly liquidity at best, or quarterly liquidity. Their investors couldn't pull out right away anyway. So it was early August, no one was able to just pull out. So they had a steady source of capital in a sense. So if they lost money and they locked in that loss and sold and sat in cash, that's probably worse than if there's a rebound that the investors couldn't do anything about. So a lot of those hedge funds stuck with what they had, and if you looked at their monthly returns, you wouldn't actually see anything. August would be like sort of an average month, an uninteresting month, right? Maybe a little up, maybe a little down. Whereas the daily P&L was like this massive drawdown and this massive spike afterwards. If you're, but at that time, PDT was a prop trading group, and we had one investor, and that investor was Morgan Stanley, and Morgan Stanley could make a decision to shut the whole thing down, and could make a decision, we're a publicly traded company, we can't handle this loss. And so the decision-making process is different, and it would have been different for, anyone who had sort of daily liquidity, for example. So it really, it depended on where you were, and you had to make the right decision ultimately for your investors at that point, regardless of what you believe.
What was the culture at PDT like?
PDT is sort of well known for being a place where people stay a long time. So, it was founded in 93. So I was a latecomer in 2007. I left in 2013. So I had a fairly short tenure there by PDT standards of, 6-ish years. There are many people there who've been there 10 plus, or from the beginning for that matter, for close to the beginning, when Pete founded the group in 93. And so it was quite quants are known for being secretive. And in some cases, secretive means that each person is in a silo. They don't know what's going on, and across the hall or anything like that. PDT is not really like that. It was more collaborative. People worked in small teams together, and very, very friendly. The collegial environment. I still have friends that I'm in regular contact with. I don't know what they do anymore. That stuff's proprietary, but we're still close friends. So yeah, it was a unique sort of culture. I'd come from a place which did not have that kind of culture, which is extremely siloed. And basically, I sat and I had my book and my code and my P&L, and that was it. And I didn't know what the person next to me, literally next to me, was doing or working on. So that was, it was nice in that sense, and it was more similar to the culture I had come from the research shop called Starmine I was at, prior to that prior job. Um, so yeah, definitely, I think that it was conducive to solving these sorts of problems because you could kind of work together and try to figure it out, and it was more of uh, there was more an environment of trying to share information, within reason, than not, and that's helpful for solving sort of a firm wide problem like this.
And so after your tenure at PDT, you go and you found Extract Alpha. Now that's going from more buy side activities to providing data, providing these alpha signals. I'm curious, what prompted you to do that? Because I imagine most people want to be on the buy side. And what was the underlying reason that you saw the need for building something like Extract Alpha?
Yeah, it was a combination of seeing an opportunity in the market and also personal reasons, as these things tend to be. So the opportunity was really, so I'll go back to the Quant Quake. So what did the Quake kind of teach us? It taught us that, a lot of investors out there are using the same stuff, similar models, right? And those similar models, why are they similar? Well, they're similar partly because the modeling is similar. That's sort of inevitable. And a lot of models are simple, or like, linear or something like that. Certainly back then that was more common. But also because the underlying data is the same. And back then, okay, you're starting a shop. What are you going to do? You're going to buy data from, you know, you're going to buy fundamental data from like CompuStat or FactSet. You're going to buy like earnings estimates from like IBES, and you're going to get some other, price market data from Reuters, what have you. You're going to combine sort of the things that are available because that's what you have. You work with what you have. If you work with that small set of things, then you are fairly likely to end up with a set of signals that are, what are kind of commonly used out there. So you might have, from the fundamental data, you might have value factors or quality factors. And then from the earnings estimates data, you might have some, estimate revision sentiment type of signals. And then you might have sentiment from, let's say, like insider trades or some other types of data. And then on the price data, you might have momentum or reversal type signals. So that's the sort of suite of things that you're kind of working with if you're talking about, let's say, public equities. Certainly a different suite of things in different asset classes. So if that's what you're starting with, if you're starting with the same stuff, you're going to end up with something close to the same stuff across different funds. But that didn't have to be the case. And so I developed a really strong interest after August of '07 in finding what we now call alternative data. We didn't have that term until, some years later, but finding other sources of information about companies. And even back then, you could find other information about companies. There was a lot of text data out there, but there was also a fair amount of structured data from various other filings than 10Ks and Qs. There was data out there from interesting companies that have been collecting it. There are companies starting to scrape data initially from the web, So there's starting to be more of this alternative data stuff out there. People are creating their own data for that matter, and I'll get to that in a bit as well. But that meant that there was this opportunity to sort of help that stuff get to market. So what I noticed is that a lot of the firms that were starting to get into the space, these data companies, didn't really know how to get into the space because they didn't have experience that I had. They didn't really know what an investor wanted out of a data set, how to present it, how to even save it as a point in time manner, how to tickerize it, how to featureize it. So all of these things, how to do research on it and prove that it has value. And so um, the opportunity initially was, hey, let's work with some of these data vendors and help them bring these data sets to market. That was the initial idea. And then, the reason I wanted to do that in the context of a data company and not a fund was more for personal reasons, and a combination of personal reasons and sort of economic reasons. So, I wasn't sitting on a giant pile of money, so I couldn't start a fund on my own. I would have had to go and raise money to start a fund. That's really hard. Raising money is hard. Even in those days, and more so now, it's very consolidated. So most of the, flows of capital go to larger funds. And it's smaller. It's hard to attract capital to a small fund. It's also true that starting a data business, or even what I started out as, which is the data consulting business, has a very low cost of capital. It was just like me and a computer at first. And it also meant that I had no boss. I didn't have investors telling me what to do. I took savings and bootstrapped this company. And that was sort of the personal reason behind it. I really wanted to kind of run my own thing and be in control of what happened, good or bad. And then that's sort of been consistent. I've never taken outside capital. This has been a bootstrap business, and we've grown it from there, just from my savings.
Now, one of the things you touched on there was that, the cause of the Quant Quake, or at least one of the causes, was a lot of these funds and trading firms were all accessing the same type of data and all building similar style models. And so those trades ended up getting crowded.
Yep.
I want to hear about today. Obviously, a lot of these firms are all using alternative data. They're all using, sentiment data. The latest thing I'm hearing about is using all these different, transformers, all these different new large language models to extract, I guess, nuance from text. And if everyone's trying to do that same thing, doesn't that data end up getting commoditized as well, and we have a similar issue? I'd love to hear your thoughts.
Yeah, I think at some point we'll get to that stage. I think we're early in the development of that right now, partly because there's a zoo of models right now, and there's a wide variety of ways to implement them. And I think over time people will converge on very effective ways to implement them. But I mean, the really simple stuff that we came out with, 10 years ago, like, bag of words type of, counting positive and negative words in a document, that doesn't really work at all for most documents. There are some vendors who still have models that do that. They're not very effective for most use cases these days. You can get more sophisticated. As you get more sophisticated, you're using some combination of maybe, fine-tuned and off-the-shelf stuff of various different, types of large language models. And there's so many of them out there right now that you can have your own twist on things. Yeah, it's also true that there are different corpora of text, right? So you can apply these models to news data, to filings, to earnings call transcripts, to web scrape data, and to product reviews, to whatever, research reports. So there's also kind of the zoo of sources out there. And so that combination of the grid of like models by sources is not all filled in yet. And we haven't found where the value lies in all cases yet. But yeah, I mean, I think like with any model, if it becomes more popular either by virtue of people converging on it or by virtue of vendors like ourselves commercializing it, then yeah, there's always a risk that things get crowded. This is inevitable. My view on crowdedness is signals get crowded more slowly than people expect. And then when they appear to be crowded, it could be two possible effects. One is it kind of gets to be table stakes, and then the return curves kind of flatten out and it's more gradual. And the other is that you understand that it's crowded because of something like the Quant Quake, where there's a sudden liquidation event, and then suddenly everyone's selling the stuff that's held by these models. It could be either one. I do think that we'll have to continue to innovate on both the models and the sources if you want to avoid that. But for now, we're in a state where it's sort of a lot of these things seem to be working well for now. And so we still have some time before we reach the maturity that those value and estimate revisions and other types of classic signals have today.
I was reading through Extract Alpha's website, and I was looking at a bunch of the different models that you've built on top of the alpha signals that you sell. And I am curious, what is the data set that you find most interesting and that your clients have found to be the most valuable in terms of delivering sustained returns?
There's a few I can mention. And I guess I can mention them because they're all different flavors to some extent, although they're thematically linked. So a lot of my research over the last however many years has been around earnings in various different flavors. Even going back way to the early parts of my career back in the late 90s. And I've stuck with that as a theme. of earnings driving returns and of different ways to forecast those earnings and to measure them. And so I'll mention three that are all related to earnings, but in very different ways. So you talked about the large language models. One of the ones that we're really proud of is our earnings called transcript model. So what we're doing here is we're taking a data source that's fairly well known by this point. It's so on the data side of things, you can get earnings call transcripts from a variety of different places, and we source it from a large vendor, from FactSet. But so in our case, it's kind of what you do with it that matters here. And so we've built a model that has exhibited really consistent returns over time and continues to do so today, even though this stuff is kind of, in the realm of what people look at quite commonly now. And that's through a combination, I think, of careful feature engineering and then sort of the downstream model as well of determining how to combine those features into a model that explicitly predicts return. So what we're doing there is we have a word embedding model and a bag of words models. We kind of look at both and we sort of combine them to build these features. And we then combine those features based on an explicit prediction of subsequent returns. And that allows us to really identify these sort of latent language features that are not explicitly sentiment. It's not explicitly, the CFO is saying something positive or an analyst is asking a question in a positive way or the answer is positive. It is more that it could be capturing themes or topics that have predicted returns positively in the past. And that allows us to have this model that's both kind of consistent, it's non-obvious, and by design, it actually has a fairly long horizon. So we're predicting the next quarter's return. So this is not a sort of short-term reacting to the event type of sentiment model. It's more long-term. So that's one, the transcripts model. And so it's around earnings announcements, right, essentially. The second one is something that is using much more standard kind of traditional data. So we get detailed earnings estimates data from the sell side. So people have been looking at this for a long time. I've been looking at it for a long time. But what we've done is just built a really carefully crafted model using interesting features from that. For example, looking at which analysts have the best track record. And these are similar ideas that were explored in my first, first research, first data vendor job at Starmine many years ago. But really going beyond that and more carefully measuring the accuracy of analysts, but also looking at what happens when peer stocks, related stocks to each other announce earnings. Are there cross-stock effects there? Also trying to measure things like the company's earnings management. So what happens when a company is reporting late? What happens when a company has negative expected earnings? What happens if there's a high variance of estimates all over the place and the company has not managed to manage expectations very well? So that's all based on really traditional standard data, but we've really kind of featurized it very, very carefully. And so that works really nicely for global equities. And then the third one is actually a really interesting data set that I first learned about when I was at PDT, actually, because the company that was collecting this data was trying to sell it to us. And then later after I left PDT, I became an advisor to the company. The company's called Estimize, and it was founded in 2011. And Estimize crowdsources earnings estimates. So it's not like we're taking the traditional broker estimates and trying to figure out who's good and who's not. We're really saying, hey, Ethan, what do you think of NVIDIA, right? Like, what's your estimate for this quarter? And you could be an investor yourself, or you could be an academic, or you could be an independent research provider, or anyone really, a student, it doesn't matter. We're crowdsourcing that data. So Estimize had been doing that since 2011, built up a really nice data set of, tens of thousands, so over 100,000 contributors over those years, and really accurate, really predictive way of forecasting earnings. So I spent a lot of time as an advisor to Estimize, and then eventually we acquired the company in 2021. So it was about 4.5 years ago, and that's been a really important addition to our company. First of all, from a staffing perspective, but also to our data sets, because it's a really unique spin on a data set that people have been collecting since the 1970s. And the next evolution is, why does it have to be the professionals who are providing this information? They might have a very narrow view of the company, and they might also be subject to compliance constraints. They might be potentially biased because their bank has an investment banking relationship with the company it covers. None of those issues exist with crowdsourced data. So we're able to create something that is very complementary to traditional data sets through this crowdsourced approach.
I'm really interested in what you mentioned about what Estimize does. And I'm curious. So suppose, like, for example, if I had gone long, every single stock that, let's say, Estimize assumes by aggregating all these different predictions, if Estimize estimates that a stock will beat earnings by, and let's say whatever, there's a positive difference between that and what analysts expect, what the market expects. If I'd gone long every stock, um, given that, would I have made money?
On average, yeah. I mean, so I should make a differentiation between what the sell side expects and what the market expects. Actually, our research has found that Estimize is actually a better reflection of what the market expects. And I'll tell you why we think that is. If a company beats the sell side, consensus number, that's considered a beat. And if it misses, it's considered a miss. If you look at the market reaction to that, it is not as significant actually as if the company beats the Estimize expectation. So when the company beats the Estimize expectation, there's a larger post-earnings announcement drift. So that the implication there is that the Estimize number is really what the market's expectation was, or at least closer to it. So I'll just draw that distinction first. So yeah, but you're talking more about before earnings. You're saying, okay, when when earnings is approaching and you see that the crowd's estimate is significantly above what the sell side thinks, would you make money by going along those companies? On average, you would. Well, I'll make some distinctions here. On average, your longs would outperform your universe's longs over a fairly short horizon, because these forecasts come in a couple or 3 weeks ahead of earnings. So you have to build your position then. And then you probably want to exit it pretty soon after earnings are announced. So this is a 2 to 4 week horizon kind of a strategy, kind of at most. So you need to beat transaction costs with that as well. So that's an important consideration. So it's the typical user for this as a data feed is a systematic hedge fund that's going both long and short, and so they're not subject to the direction of the market, and also where they are able to trade efficiently enough in their universe of liquid names to not get impacted by the costs. And honestly, most people, and this goes for any of the factors that we provide, most of our clients are not using these things in isolation. Now, they might not tell us how they're using them, but most likely they're taking these signals and they're combining them, and the estimate signal might be one of 10 or 100 or a million that they use. And so the hope is that the incremental alpha that you get from making that particular trade, or by overweighting that type of name in your portfolio relative to what you would have without having that data set, overcomes the transaction costs plus the cost of the data set, essentially. And so, yeah, apparently there are enough hedge funds out there who would think that trade-off is worth it, that it's that is an economically viable data set.
Now, the other data set you mentioned, the first one, I find that also very interesting, because you mentioned that there are certain words, it's not just positive sentiment or negative sentiment, but there might be certain words that are unintuitively predicting returns in the future. And I'm curious about how you make these data sets pure. And what I mean by that is, for example, let's call it 2023, 2024, I imagine if the word AI had come up a lot in a earnings transcript, that would have been a strong predictor of returns, just because AI related stocks, semiconductor stocks, wherein maybe Jensen Huang's talking about AI, or Sundar Pichai. I imagine, those stocks tended to perform well. How do you deal with that problem? And I'm just curious.
Yeah, there are a few ways to answer that, because you could imagine that some of these words might be great predictors, or they might be buzzwords and they have a temporary positive effect, and then that might reverse over time. So there could be a trendy theme or something like that that reverses. So I think one way to address that is through diversification, both on the modeling side and also on the implementation side. On the modeling side, we're not really, the model's not looking for particular keywords that are going to capture like 10xers, right? It's basically looking at every word in the document and every cluster of words in the document, and looking at those that for long periods of time, for years, have predicted returns. So we're not, although we do update the model every quarter, we're not just looking back at the last quarter and what predicted returns then, we're looking back over years. And so that last quarter is important, but it'll be combined with every other quarter that we look back to for the last several years. So there's that diversification. And then in the implementation side, you're also likely to, if you're using this stuff, if you're building a systematic portfolio around it, you're not just buying a couple of names, you're buying a couple hundred names and shorting another couple hundred names across all sectors. And so the fact that, AI related, mentions of AI would be related to outperformance would be somewhat diluted across the other many different names you're going to buy. And you're probably going to have a portfolio that's not just tech or not just companies that are directly impacted by AI. You're probably going to have diversified. You might not even be taking sector bets at all. You might have a long portfolio that effectively reflects the market's distribution of sectors and industries, and a short book similarly. So you're not taking any industry or sector bets. And so, yeah, I mean, I think that diversification is part of it. And, I guess the other thing is that, we're looking for groups of words that all kind of occur together. So it's not just AI and machine learning and probably like sort of associated words. And we're forecasting from those things returns that are also adjusted for risk. So we're actually looking for returns that are not explained by industry and common risk factors. And if you do that, then you won't be you're not looking for for words that will be predicting tech stock returns. You're looking for words that will be predicting tech stock returns relative to other tech stocks, right? So if a word is pervasive across an industry, you probably wouldn't bet on that word or that cluster of words. You'd probably be betting on the things that are differentiating within an industry more so.
You you clearly still really understand what's happening with all these different trading firms, in that they're actively involved in providing them with suitable data to trade based off of. I imagine you still have the skill set to build out your own firm. Have you ever thought about, striking it out again on the buy side and building up maybe a systematic hedge fund? Curious.
I mean, certainly the question comes up a lot, and the nastier version of this question is, if your models are so great, why aren't you trading them? They must not be so great, right? So that's the less friendly way to ask the same question. It comes up all the time. It's probably the number one most frequently asked question, and there are a couple of answers to it. Some of which go to the economics of the company that I've built, and some of it go just to personal stuff again. So, I mean, the answer is similar to what my thought process was like, over 10 years ago when we started this firm. It's essentially that, first of all, we now have a profitable business that's growing nicely, that is providing data to many systematic hedge funds. Certainly, if we went off and on the side started a fund, I think they wouldn't be very happy with that. There might be a thought that we'd be effectively front running the data that we're providing. Now, whether we would or wouldn't do that, we would probably want to have access to the data the same way everyone else was, but it does, and at the same time. But that would be a concern. It would be a legitimate concern, and it would certainly be, it would be a threat to our existing business to do that. But I think the more practical answer to it is that, again, we can run this business relatively cheaply. We have no significant regulatory and compliance costs. We don't have to go out there and raise capital. Raising capital is really, really hard. So raising capital for a startup quant fund is extremely difficult, time consuming, and very few investors want to be a day one investor in a fund, and especially a small one, and especially where they are a majority investor. So a lot of allocators will say, I'm not going to be more than 25% of any fund that I get into, and I'm not going to invest in anything that doesn't have a 3-year track record. So starting from zero is really tough. And so the more likely route is going in-house at an existing, fund of some sort and becoming a pod. And that's something that would just destroy the business we build. I mean, if we had a business that was a pod at, one of these large multi-strat shops, I don't see that anyone else would want to buy data from us. So, and then on the personal side, that again means having a boss. Not really interested in having a boss. So, so there's that. So I guess a few different ways to answer that question. I mean, I think, right now, the stuff we're doing is the fun stuff. It's the data sourcing and the research and the building of the models. And that's really great. And then we get to talk to a lot of people around, we don't necessarily hear any gory details of what we're doing, but, we have friendly contacts across the industry who like to engage with us as, an independent research firm. And you lose a lot of that if you go in-house. So it's, I think we're in a pretty comfortable spot, even though that temptation is probably always going to be there because, running money seems more glamorous than running a boring data company, but a boring data company can be pretty fun. So
I normally ask this question towards the end of podcasts. And the question goes something like, if you were young today and all this new technology is occurring, all this AI and, large language models, agents taking over jobs, what would you do? But when I look at my YouTube statistics, for the last podcast, I think 0% of the people who watched that video were below the age of 25, and most were 25. Most were 34 to I think 34 to 40 something is the estimate. So I'm going to frame it in a different way. For people who are in the middle of their career, perhaps doing tech related roles or within the quantitative trading space, what advice would you give such that they're able to continuously reinvent themselves and keep improving to essentially stay ahead of the curve?
yeah, I think so. We're obviously at a very disruptive moment right now where this AI stuff is becoming pervasive. Every single person's using it for various different things. We use it throughout our organization. So we use it, for building models, obviously, but we use it for, tracking sales activity and for identifying prospective clients. And we build tools around that. And we use it for generating code and for, translating code from one language to another. So many different use cases across the organization. And I think the good thing about quant finance, if you are in quant finance, is it is, I think the barrier to entry has dropped over time. And we see that there are a lot more quants now than there were, 10 years ago, 20 years ago. But that being said, there's still a high reward or ROI to creativity and to the type of creativity that right now an LLM can't have. So, and that's not to say that there isn't creativity in other industries, but I think if I were, someone new, earlier in the career as like, a family doctor or a lawyer or something like that, I'd be really concerned because like that, that it's massively disruptive to that stuff. And I mean, I'll go to Grok before I go to any expert a lot of times. Right. But but with quant finance, it's a little bit different. There's still a lot of room for creativity, for out of the box thinking, for finding data that hasn't been found before, things like this. And you can use and leverage those models. So it's actually for now, it's at a point where it has a multiplying effect and not a deleterious effect. So I think that'll last longer in quant finance than in most other disciplines. So right now, I think we're not being eaten by AI. That time may come. I don't think the AIs are smarter than a really good creative researcher today. And I think there's some wiggle room there. But so I think the advice would be to really stay on top of what these things are capable of and use them to your advantage as opposed to, freaking out about it at this point.
100% agree. And yeah, I think this industry is very fortunate. And when I think about, like you've said, doctors, lawyers, especially the ones early in their career, consultants. I mean, just the other day I forgot the name of the startup, but like a fully like AI native investment bank. I found that like fascinating. I was like, whoa. I mean, if they're able to do it, the amount of business that they can generate is, I can't even imagine the disruption that'll take place. And I don't think that these these large investment banks are under threat now, but I think as management gets older and older, and the sort of human aspect diminishes. The edge that they have in terms of the human aspect, goes down ever so slightly. I think that really gives these smaller firms the opportunity to come in and sweep up all that market value. I'm curious about where you see the future of the uh, of of capital consolidation in the quantitative trading space, because I feel like now the multi-managers are so large. Millennium, Citadel, these the trading firms are so large, and you're on. I mean, I'm sure these huge hedge funds, some of them buy data from you. Um, in terms of edge, like they have all the money in the world. They can hire the best talent. They can buy the best data. They have the best systems to aggregate it. They have the best risk management systems to hedge out, all these different exposures. They've had people working during periods like, like 2007 during the Quant Quake. They have the know-how, and they're a lot more experienced, and they can deal with these situations a lot better. Do you think that these multi-managers, these huge hedge funds, will continue to get larger, and that smaller players are essentially doomed? Would love to hear it from you.
Yeah, I would like to think that smaller players aren't doomed. I think it's a real, like I mentioned, it's a real challenge to start a firm. If you manage to do it and to get to a size where you can cover your costs, and I don't know what that point is, maybe it's 100 million or 200 million in AUM, then there still can be an advantage in being a small player because you can be extremely nimble. You can make decisions about hiring people, acquiring data sets quickly. You don't necessarily get the cord pulled on you if you have a drawdown, like you might if you're a pod at one of these shops. Um, and you have a lot of flexibility. And if you're small or smaller, you can trade less liquid names, and that's where the alpha is, right? So with a lot of signals, there's more alpha and less liquid names, and if you're not big, you can take advantage of that. So I think there's space for smaller players still. I think it's harder in the sense that they don't have these massive budgets, and at least for now, the pass-through structure where the investors are paying for all this stuff anyway, right? Um, I do understand the economies of scale, multi-strats, and those economies of scale are especially evident among the discretionary long-short folks where at a multi-manager, the firms, the trades can be crossed, and they can impose, a risk management system on top of it, so they can really isolate the alpha that discretionary managers can generate. That makes total sense. In the quant space, it's not as obvious because a quant book can be quite risk controlled on its own, right? So it doesn't necessarily need to live within a multi-strat manager, as long as it can produce, high, sharp, consistent returns over time without significant drawdowns. So I think it's still possible out there, but it's certainly gotten tougher, especially at the launch stage. Unless you are backed by a large and existing investor, it's very, very hard to get out there and launch a firm. But we know folks who've done it. They tend to really like what we're doing because they can leverage firms like us to essentially get alpha out of the box. They don't have to build everything themselves from day one. They might want to build everything themselves over time, and that's fine, and we can help them get started. And so we do a lot of work with new launches, big and small, and work a lot with funds kind of helping them grow and growing with them. So we really like the space, and we think that there is room for small funds, but they're always going to be challenged by these behemoths for sure.
Vinesh, you've been in this industry for quite some time. You've worked at PDT, an elite trading firm. I'm sure during, especially what you do now with Extract Alpha, I'm sure you've met, tons and tons and tons of systematic hedge fund managers, people who work at various quant hedge funds. Um, and so I'd love to hear it from you. What has separated the people who continue to perform in this space year after year after year from those who maybe can perform for a little bit, but ultimately maybe fly too close to the sun and get burned in the process? What makes the exceptional players in this space?
Yeah, it's probably a combination of things. One would be, the obvious thing you mentioned, flying too close to the sun. That speaks to risk control. Quant quants are naturally risk averse, especially, sort of traditional quants, where if you see the world through this kind of factor lens, you get very paranoid about factor exposures and what your, latent factor exposures might be, and things that you haven't covered. And you talked about crowding, that'd be a good example of one. So certainly risk management is sort of key to that longevity. And then the other key is continual sort of evolution. And to my mind, that means modeling techniques and data, right? So evolving the techniques you use to attack data sets, and then broadly increasing the number of data sets you use. So if you're going to survive, you can't be doing those same things that we were doing back in 2007. And those strategies, that just wouldn't work. It wouldn't be economically viable to run a hedge fund on the 5 to 8 factors that everyone loved to use back then. It doesn't mean to say that those aren't a part of a lot of strategies, but now if you're going to survive in the current environment, you need a lot of alphas. You need a lot of potential sources, any one of which could stop working at any given time. So you need to massively diversify not just your book, but your book of signals. And that, I think, and also to the trade-off, of course, you have to have confidence in them. So how many signals can you really have confidence in? Well, that requires time to gain that confidence, right? So there's an approach where you just build every signal in the world and you just throw it into your book and you see what sticks. I think the better approach most likely is to use some judgment, and hopefully you have that judgment to figure out, is there an economic intuition as to why the signal should be predictive of returns over whether it's a second or a year. It doesn't matter. It's a similar thought process. Different data sets, a similar thought process. And so, yeah, I think maintaining that sort of rigor in the face of the need for lots and lots of alpha signals is probably the toughest balancing act when it comes to creating a strategy that'll last a long time. And that strategy here does not mean a set of signals, because that set of signals has to evolve over time. I guess that's the distinction I'm trying to draw. If you're complacent with the signals you're using today, then you'll very clearly learn to not be complacent at some point.
Wonderful. I think that's a great place to leave our conversation. Thanks a lot, Vinesh. I really enjoyed.
Thanks for having me. Pleasure.